If you claimed a home office, took crypto profits, or forgot a line on your tax return, the CRA might already be watching. And here's the twist. You don't even have to break the law to get audited. In this video, you'll learn the 5 most common red flags that trigger CRA audits in Canada, including one that almost guarantees a second look, even if your taxes are clean. The pandemic changed everything. Suddenly, millions of Canadians started claiming home office expenses. And the CRA, they noticed, if you're writing off part of your rent, internet, or electricity, they'll want to see 2 things: proper receipts and a legitimate workspace. What they don't want to see? Someone claiming half their apartment as a business zone because they took one Zoom call at their kitchen table. If the numbers seem too high or your claim doesn't match your employment situation, that's a red flag. Imagine you made $82,000 last year, and this year you report $21,000. The CRA doesn't assume fraud, but they will assume you owe proof. A big income drop might be totally valid: job loss, career change, or going full-time freelance. But without proper documentation, especially if deductions increase at the same time, you're likely to trigger a review. Pro tip: always keep letters of termination, client contracts, or EI claim confirmations on file. You think no one notices that Etsy shop, TikTok brand deal, or Saturday photography gig? The CRA's AI probably does. Platforms like PayPal, Etsy, Uber, and Stripe often report income directly to the CRA. And if your name shows up, but that income doesn't appear on your return, you could be flagged instantly, even if it's just a few $100. Because if they catch one unreported stream, they'll start looking for more. Crypto is not anonymous anymore. The CRA has cracked down hard since 2021. They've subpoenaed records from crypto exchanges and even cross-checked blockchain addresses. If you sold Bitcoin, Ethereum, or even traded NFTs and didn't report the gains, your file could be on a list already. And remember, even swapping one crypto for another counts as a taxable event in Canada. One viewer said they got a review letter after moving coins between their own wallets because it looked like a sale. This one's the most dangerous because it doesn't even require a mistake on your part. Let's say you report $38,000 in income, but your Instagram shows a new BMW, a Cancun trip, and dinners at the Keg twice a week. If the CRA sees a lifestyle that doesn't match your declared income, they can launch what's called a net worth audit. That means they look at your assets, spending, and lifestyle, not just your tax return, to decide if your reported numbers make sense. And yes, they've done this based on social media. Getting audited doesn't mean you're guilty, but it does mean you're going to need proof and time. The best way to stay audit-proof: keep receipts. Avoid making aggressive deductions without backing. Report everything, even side gigs and crypto. And if you're not sure what to claim, ask a tax professional before the CRA asks you. If this helped you, tap like so more Canadians can avoid these audit traps. And if you've ever been audited, tell us in the comments what triggered it. You might help someone else avoid the same mistake. This is the Forgotten Dollar, where we make Canadian finance simple, smart, and sometimes a little scary.